Here in the U.S. Consumer Price Index report for March showed overall inflation ticked up. It is the third straight increase in inflation and reflects some stalling when it comes to cutting price pressures. Karina Mitchell reports from New York.
Well, the door has all but slammed shut on any potential for a rate cut in June. Bond markets now pricing in that we will see 2 rate cuts this year. At the start of the year, markets were expecting that we would see up to 6 or 7 cuts this year. The problem was the CPI report for March, which came in much hotter than anticipated. We expected a rise of 0.3%. Instead, we saw a rise of 0.4% month over month. The headline number then went to 3.5% year over year. And core CPI also hotter for the month and coming in at 3.8%. This is much hotter than the Federal Reserve wanted to see, or for that matter, Joe Biden or the White House. And the bigger problem here is that the gains were actually quite broad-based across several categories that went up just by a little bit in each of those categories. So, for example, food was up by 0.1%. Gas prices were up. Energy prices are up. But the two big culprits here, more than 80% of the year-over-year gains in inflation are attributable to 2 things. Auto insurance prices are rising and shelter costs keep rising. They were up by 0.5% in March after rising by 0.4% the month earlier. The Fed keeps saying that shelter costs will eventually go down. That will help drive down inflation, but we haven't seen it yet. And the thing that is holding the consumer together right now is that we have an exceptionally strong labor market at this point in time in the U.S. Wages are still quite decent, and we're seeing a better balance between supply and demand. But, how long does that last with an American consumer whose pandemic savings have all been spent and debt is starting to rise? So the question is, what does the Fed do after seeing this report? It was a critical report. It was a wake-up call for this U.S. central bank because it shows that inflation has been rising for 3 months. That just is not an anomaly. It is a trend. January could have been the outlier, but we saw in February all 3 measures of inflation went up. And then we see this hotter than anticipated report. That is giving power to the statements of some of the Fed members, Bostic and Waller, for example, who are pushing for fewer cuts and waiting later. The Federal Reserve in March produced their dot plot, which showed that we would get 3 rate cuts this year. They may now have to revise that lower. Some people are saying that we won't see any rate cuts at all. And former U.S. Treasury Secretary Larry Sumner says that the Fed's next move could well be a rate hike instead of a rate cut. Wall Street didn't like any of that news. Karina Mitchell, CGTN, New York.
With me now to break down all these inflation numbers a bit more is Ted Rossman. He's a senior industry analyst at bankrate.com and creditcards.com. Thank you so much for joining our program today.
Of course. Thanks for having me.
Well, let's first, of course, talk about U.S. inflation. It ran hot, as we just mentioned, at 3.5% in March. So definitely there seems to be less of a case now for the Fed to reduce interest rates just a few months from now. What do you think the Fed will do? What do you think their next move might be?
Higher for longer definitely seems to be the tone here. So that's bad news for borrowers, of course. Credit card rates are already at record highs. The average is 20.75%. I don't see that coming down in any meaningful fashion anytime soon. Mortgage rates are a big deal. The average 30-year fixed rate mortgage has edged back above 7%, could even be a little bit higher this time next week. There are definitely some ripple effects to this. Savers are the ones who are benefiting. You can still get over 5% on a federally insured savings account. Short-term CDs are looking good, over 5%. For the more attractive yields there as well. So it's kind of this tale of 2 cities. If you're borrowing money, this is bad news. If you're a saver, it's good news. And unfortunately for consumers buying things, higher prices are proving to be a bit more stubborn than we had hoped.
I want to talk about what is keeping inflation so stubbornly high here in the U.S. A lot of experts and the Fed itself had expected prices to cool down by now, and now we're looking at 3.5%. What's going on here?
It's not so much physical goods, it's more services, things like housing, which is a huge item, the biggest line item in most households' budgets. Tight inventory has really led housing prices to remain much higher than expected, and not just for purchases, but for rents as well. That's been stickier than expected. And then other services, things like insurance costs have jumped tremendously. Some of that really goes back to the pandemic era supply chain disruptions, the fact that parts cost more, the fact that labor costs more. All these things are combining. I mean, one sort of interesting flashpoint on this was California's recent $20 minimum wage for fast food workers. I mean, that's maybe a small example in the grand scheme of things, but I think it's emblematic of some of the cost pressure that businesses are under, and then they're raising prices. Now, some, like President Biden, say that there's price gouging going on and that these companies ought to lower prices, and they're kind of taking advantage of consumers. But unfortunately, even slower inflation doesn't mean prices are going back down. It just means they're growing more slowly. I think this has been a difficult reality for a lot of people to adjust to.
You mentioned some of the impact on the average U.S. consumer in terms of borrowers and savers. In terms of daily life, food, gas, what are they going to be experiencing as an impact from this inflation?
The biggest household item that people are noticing on the rise is housing costs, particularly for those who are renting or those who are looking to enter the housing market. I mean, really high prices there. That's been a big issue. Recently, gas prices have been ticking up. They're up about 7% over the past month. And I think that's significant because we're coming into the spring and summer driving season. But it's not just the gas you put in your car. It's also the fact that when transportation costs go up, then the cost of moving goods from point A to point B is going to be more expensive. So I think that could definitely have some ripple effects. Gas prices are a huge psychological inflation indicator too, because people drive around, they see the signs, they feel like prices are higher, and they are higher. But it's other things too. It's your insurance bill. It's just about everything, really. I mean, even categories like food, which are experiencing lower inflation than a year or two ago, prices are still growing, and they're building off a higher base. That cumulative effect is significant. And in total, it's about 20%. So this basket of household goods that you bought 2 years ago, well, now it costs about 20% more. That's really weighing on people.
And now, of course, the springtime, a lot of people are looking for homes. This is, the time of year when that usually happens. So for home buyers, potential home buyers, what should they do? I mean, given the climate we're in right now.
The inventory situation is really dismal. There's just not that much on the market. And that's really created a strong seller's market, because what is out there is seeing a lot of bidding wars, and sellers are really able to command a high price. The double whammy for buyers, especially first-time buyers who don't have any equity to trade in, is the fact that they're facing higher prices and higher mortgage rates, and they don't have any equity to fall back on. So the housing market is pretty stuck right now. A lot of existing owners are not looking to move because they may have a 3 or 4% mortgage rate that they locked in a few years ago, and now they don't want to trade that for a 7 or 8% rate. I think this whole higher for longer thing has the most direct impacts on the housing market. We had hoped that maybe mortgage rates would fall through the 6s this year, maybe be close to 6% by year's end. That's looking less and less like a reality.
Hopefully we'll get some better news the next time we talk to you. Ted Rossman, thank you so much for your expertise today.
Thank you.